If someone offered you the chance to invest in companies like SpaceX, OpenAI, Stripe, or Anthropic before they go public, would you rather own a piece of one specific opportunity you believe in, or spread your capital across a wider group of startups and let winners emerge over time? That choice can completely change your risk profile, your liquidity timeline, and your potential returns. And many accredited investors don't fully understand the difference between investing through an SPV and investing through a traditional venture capital fund. On the surface, they can look similar, but can give you exposure to private companies, involve longer holding periods, and carry significant risks. But the way each works is completely different. In this video, I'm going to break down their structures, where each one tends to fit, and how investors should think about choosing between them. And before we get into the details, if you're an accredited investor and would like help evaluating private market opportunities, I've included a link in the description where you can schedule a free consultation. We help investors look at opportunities like SPVs in the context of their broader portfolio, goals, risk tolerance, and liquidity needs. Now let's start with venture capital funds. For a long time, if you wanted exposure to venture-backed companies, your options were limited. You typically invest in a venture capital fund. The fund manager would raise capital from investors, then deploy that capital across a portfolio of private companies over several years. Instead of making one concentrated investment, the fund is making many, sometimes dozens, sometimes even hundreds. Most startups don't become massive winners. Some fail completely, some produce modest results, and a small number can drive most of the returns. That's why venture capital is often described as a power law business. The outliers do most of the heavy lifting. Think about companies like Uber, Airbnb, Facebook, or Nvidia in their earlier stages. A single major winner can change the outcome of the entire fund. That's the core appeal of a venture capital fund. You don't have to pick one private company and hope you're right. You're relying on a manager to source deals, evaluate companies, build a portfolio, and manage the process over time. You can get diversification across multiple investments. That diversification can help reduce the impact of any one company failing. And for investors who want exposure to innovation without analyzing individual startups, they can be a useful structure. But there are trade-offs. When you invest in a venture fund, you usually give up control. You may not know every company in the fund that you will invest in and you're committing your capital to. You may have limited visibility into the timing, pricing, and allocation of individual deals. You're also paying the manager's judgment fee. If the manager chooses well, the fund can perform well. But if the manager misses, diversification doesn't automatically solve the problem. Fees also play a role. Traditional venture funds often include management fees and carried interest. The classic structure has often been referred to as 2 and 20, although actual fees can vary by manager, fund, and strategy. Those fees reduce net returns, so they need to be reviewed carefully. Now let's compare that to an SPV, or special purpose vehicle. An SPV is usually created for one specific investment. Instead of investing across a portfolio of startups, an SPV is typically formed to invest in a single company. For example, let's say a shareholder in SpaceX wants to sell some shares. A sponsor may form an SPV to acquire those shares. Investors contribute capital into the SPV. The SPV purchases the stake, and investors now have exposure to that specific company through the structure. That's the main difference. A venture fund gives you broad exposure, an SPV gives you targeted exposure. With an SPV, you usually know the company before you invest. You can review the opportunity, the valuation, structure, the fees, and the potential timeline before deciding whether to participate. That creates more precision. You're not committing capital to a manager who will choose future deals. You're deciding whether you want exposure to that specific company at that specific time under the specific structure. And for many accredited investors, that's the appeal. They may already have a strong view on the company, the sector, or trend. Artificial intelligence, aerospace, fintech, cybersecurity, healthcare innovation. Instead of investing in a fund that may only allocate a small percentage to that area, an SPV can allow for more direct exposure. But precision cuts both ways. If you're right, the upside can be compelling. But if you're wrong, there may not be a portfolio of companies inside that investment to offset the losses. That's where venture capital funds still have a major advantage. They can protect investors from being overly confident in one company. Even professional investors struggle to predict which startups will become category leaders. Private markets are full of companies that looked unstoppable and then they stalled. They're also full of companies that looked small and overlooked before becoming massive. A venture fund spreads that uncertainty across a portfolio, so you don't need every company to work out. You just need enough winners to outweigh the losers. That can make sense for investors who want private market exposure without trying to evaluate each individual opportunity. SPVs require more conviction and more discipline. Before, when a famous private company becomes available, it's easy to get distracted by the name. SpaceX, OpenAI, Anthropic, Stripe, those names attract attention. But the company name doesn't tell you whether the deal makes sense. The valuation still has to be evaluated. The share class still has to be understood. The fees still have to be reviewed. The liquidity timeline still needs to be considered. And the position still has to fit within the broader portfolio. A great company could still be a poor investment if the entry price is too high or the structure works against the investor. That's why access alone isn't enough. You need to understand what you're buying, how you're buying it, and what has to happen for the investment to work. If you'd like help walking through that process, there's a link in the description where you can schedule a free consultation. We'll look at your goals, your current portfolio, the types of private market opportunities you're considering. Then we'll help you think through whether SPVs, venture funds, or other strategies make sense for that situation. Okay, now I want to talk about liquidity. This is where many investors underestimate the reality of private markets. Whether you invest through an SPV or a venture capital fund, you should expect your capital to be tied up for years. This is why short-term investments are not considered private market. A venture fund may spend several years deploying capital before it even starts harvesting investments. The manager may invest gradually, support companies through multiple rounds, and wait for exits through acquisitions, IPOs, or secondaries. That process can take a long time. An SPV is usually tied to the outcome of one company. If that company goes public, gets acquired, or has another liquidity event, investors may receive the proceeds, but there's no guaranteed timeline. The company may delay going public, it may raise more private capital, it may face setbacks, it may never produce the outcome investors expected. So, while SPVs can feel more direct, they're still illiquid private investments. Investors need to plan as if the capital won't be available for years. Fees. When it comes to fees, investors often assume SPVs are cheaper than venture funds because they're focused on one investment. But that's not true. Venture funds often charge management fees and carried interest. SPVs can also include administrative fees, setup cost, carried interest, or other sponsor economics. The structure varies from deal to deal. So instead of assuming one is cheaper, investors should review the actual fee arrangement. What are the upfront costs? Are there ongoing fees? Is there carried interest? When does the sponsor get paid? And what happens if the investment takes longer than expected? Net returns are what count, and fees directly affect what the investor keeps. So, which is better, an SPV or venture capital fund? The answer depends on the investor and the role the investment is supposed to play. A venture capital fund may make sense for someone who wants broader diversification, professional management, and exposure to multiple private companies through one commitment. An SPV may make sense for someone who wants targeted exposure, greater visibility into one specific company, and the ability to evaluate each opportunity individually. Some sophisticated investors use both. They may use venture capital funds for broad private market exposure, then allocate selectively to SPVs when a high conviction opportunity appears. It doesn't have to be either or decision. It can be a core and satellite approach. The fund provides broader exposure, the SPV targeted exposure. But either way, the key question is the same. Do you understand the opportunity, or do you just recognize the company name? That question should come before any commitment of capital. Private companies can generate excitement. Headlines create demand. FOMO moves quickly. But sound investing requires a deeper look. You need to understand valuation, risk, liquidity, fees, potential outcomes, and portfolio. A venture fund gives you a diversification and management experience, while an SPV gives you precision and targeted exposure. Neither structure is automatically better. The right choice depends on your goals, your risk tolerance, investment horizon, available capital, and overall strategy. As private markets continue to expand, accredited investors are going to see more opportunities outside traditional public markets. And that could be a good thing. But more access also means more decisions. And better decisions come from understanding the structure before chasing the opportunity. So if you'd like help evaluating private market opportunities, understanding SPVs, or deciding how these investments could fit into your broader portfolio, click the link in the description and schedule your free call now. We'll walk through your goals, answer your questions, and help you think through whether private market strategies align with what you're trying to accomplish. Because when you understand how these investments actually work, you're in a much better position to decide which opportunities deserve the attentions and which ones don't. Thanks for watching, and I'll see you in the next one.